I'm Sue Wilson. I am part of the Enterprise Community Investment Syndication Group. Myra and I both work in the technical services area, and we work at helping structure our transactions. And today, we're going to start talking about the low-income housing tax credit and talk a little bit about the energy credit programs, and then go into sort of an update on what's going on legislatively, just to give you an idea of the program. So with that, let's get started talking about low-income housing tax credits. The tax credit program is a form of subsidy. You don't think of it as subsidy in the way that dollars are handed out to people, as you might think with a lot of rental subsidies. This is a subsidy that is created within the tax code and is actually a benefit that is passed on to those that invest in the housing. So those that put money into the development of the housing will then in turn receive tax benefits, and that motivates them to put their money into the housing. This was created as part of the 1986 Tax Reform Act, and this was a program that was intended to simplify the law and make some changes, and one of the changes created Section 42. And it was modified in 2008 and 2009 when the industry had been running into some issues because of the way the program was structured that made it less effective. And in 2008 and 2009, there were some modifications that significantly strengthened the credit program. So between 1987, when it first came about, and 2008, the program went through a lot of sort of starting pains, and it was a permanent program, but it still needed work, and that's when they made a lot of changes. Later, when we talk about updates, we'll be talking about some of the other things that might make the program stronger even today. It is created within the Federal Internal Revenue Code, but one of the strong features of it is that it's administered by the various state housing agencies. So it is not a one-type-fits-all around the country. It is considered a resource that each state will figure out the best way to use. Each state designs a plan for how they're going to use this resource and uses it to the best of their ability. They don't have to conform to the same program nationwide. This differs from other federal programs that were administered on a national level. These are administered and even enforced at the local, each state, and even more within a state, they can subdivide that into even closer monitoring and closer allocations. Each state receives an amount of credits that they can then, it's an annual amount, which is based on the population of the state, and that turns into annual credits. So in 2003, the amount was set at $1.75. Previously, it had been $1.25. In 2003, it was raised to $1.75. In 2008, the amount was increased. At that point, it was $2, and the amount was increased temporarily for 2 years to $2.20 and a little bit higher than that in 2009. It was at a time when the economy was suffering and there wasn't as much investor dollars, and in order to help get through this hurdle, they did a temporary increase in the amount of credits, which made more equity available to help with the financing of housing. After 2009, it returned to the annual rates, sort of taking up where it left off, and here we are in 2017, and the amount of credits, annual credits per capita, is now $2.35. So housing credits can finance a variety of things, but the common denominator is it's rental housing that is affordable to people who make below 60% of area median income. So this can include new construction and rehab, and Enterprise's portfolio covers both. We do a lot of new construction. We do a lot of rehab and adaptive reuse. It can cover acquisitions, but the key thing is it has to be an acquisition that includes rehab of the property as well. It can provide housing for families, sometimes large families, sometimes smaller, but it can also provide some very needed housing for special needs tenants, single room occupancy, and the elderly. These are special populations, and projects are often meant to specialize in providing affordable housing that will serve these populations. Often it will include some supplemental services that these populations might need. But again, as long as it's rental housing, it will be covered. Now, what it will not cover will be things like dormitories at schools or student housing. It will not cover nursing homes. In that case, the service is more important than the housing itself is. However, sometimes assisted living with limited services can qualify because, again, it depends on the relationship of the needs versus the housing. If it's predominantly housing, and there are rulings where the IRS has said when it's predominantly housing, it can qualify. But when you get to the extremes of a nursing home or a college, it won't work at that point. The housing can be in urban areas, rural, suburban, it really doesn't matter. We do a good bit of urban and rural. We do some suburban, but our niche is probably more in the urban and rural areas. In addition, at some point, there was the program was a first come, first serve, and the people who first went in there would get the allocations of credits because, again, it's a finite amount of credits that each state gets. And they came to realize that there were a number of projects that couldn't pencil out and compete with some of the suburban locations. Predominantly, you're talking about some of the inner city and the very rural where there were high costs but incomes were low. And there was a realization that the projects that were the most needed in these inner cities and rural areas were the ones that were the most difficult to make work because they could not, that the incomes were so low that the people couldn't cover the costs that, you know, they would need to support to get the housing done. So they were aware of that, and in 1999, when the program was kind of revamped a little bit after they'd had 3 years to try, 1989, they came up with some additional incentives for the projects that were in these high-cost or difficult-to-develop areas. And the definition of these was actually block by block. It was based on the incomes and the populations of these areas, and we called them qualified census tracts, which were the areas that had the highest concentration of poverty, and difficult to develop, which was defined as those that had the highest cost to develop coupled with the lower incomes, therefore the people couldn't pay the rent. And this primarily is going to occur in the inner city areas where costs are a bit higher but incomes are a bit lower, and in the rural areas where infrastructure is necessary yet incomes are low and the people can't pay the cost to support it. In those cases, they built in an extra 30% boost in the basis, whatever you paid, so that these projects could compete. So in other words, if we had two projects that each cost $1 million, one was in a very suburban area where the incomes were higher, and one was in the inner city where incomes were lower but costs were higher, but they both cost $1 million. In the case of the one in the suburban area, they would raise credits based on $1 million, but in the case of the high-cost area, the difficult-to-develop area, they would be raising tax credits based on $1.3 million. And as we'll see later, by that 30% increase allows you to raise more equity and keep those units affordable. So we'll see an illustration of that in a little bit. Donna, it's not advancing. Okay, it did this time. Okay. All right, so how do these credits work? Okay, well, first of all, in order for a unit to qualify, the people, when they move in, cannot earn more than 60% of area median income. So that means that the families are going to be income restricted, and we'll see in a minute that the rent that they are going to pay is going to be what is affordable at no more than 60% of area median income. So the units have to be both income restricted and rent restricted, so they're affordable to people who are going to be living there. The investors are going to earn a dollar-for-dollar credit against their tax liability based on the amount of credits the project generates. The investors will also get benefits for losses that are inherent in these projects. In other words, in our $1 million example, they not only generate credits, but they're also going to generate some losses, and they're also going to pass to the investor. So the investor will get dollar-for-dollar credits, but they're also going to get losses. Generally, the credits are going to be received over the first 10 years of operation, but they don't receive credits until a tenant actually occupies a unit, a qualified family occupies the unit. In certain instances, which is kind of rare, where projects are rented up over a couple of years, some of the, I'm explaining this a little wrong, some of the credits will be recaptured if the project doesn't comply. So one of the key things about this program is that previous programs, money went in as a grant, and if the project went out of compliance, there was no way to enforce it. However, in this program, in the event that the project goes out of compliance, anytime during the 15-year period, some of the credits that the investor got would be paid back. And investors don't want to pay it back, so investors will require a lot of monitoring of the projects to make sure that it doesn't go out of compliance. It's very rare to see a project go significantly out of compliance. There could be a unit that goes out which may or may not have a consequence, but as far as large events, you don't see many because it's being closely monitored by the investors who do not want to pay for that. So as I mentioned, there's some threshold elections about what qualifies, basically who can live there and how much can they pay. An owner has a choice. They can elect to rent no less than 40% of the units to people earning less than 60% of area median income, or alternatively, 20% of the units at 50%. So they have an election they can make, one or the other. Most of the projects are going to elect to make the 40-60 election. So at least 40% will be rented to families earning less than 60% of area median income. That being said, only those units that are rented to people below the 60% will qualify. So if a project is only renting 40%, so barely making the election, they're just going to rent 40% of the units to qualified families, then the owner will only get to take credits on that 40%. If they're below 40%, they won't get to take it on anything. But if they meet the 40% threshold, then they can take it on 40%. Realistically, most projects are 90 to 100% qualified. So if they're 90%, they've met the threshold, but they're going to be able to take credits on 90% of the basis. In addition, the rent has to be restricted. So this tells you how much the tenants can pay. And what they can charge for rents and utilities will be limited to 30% of that threshold income. So if 60% was the election they made, then the tenant, including utilities, cannot pay more than 30% of the threshold income. And that's what makes it rent restricted, because you figure out what the utilities are for the unit, and the difference between the 60% threshold and the utilities is the max that the owner can charge. That makes them rent restricted. Okay, one of the things that they do is the tenant has to definitely qualify by being under the income limit. As far as the rent restriction, you don't have to set a rent for every single unit. So when you set the rents, you're going to look at what the rent restriction would be for a specific apartment or unit based on the number of bedrooms and 1.5 people per bedroom. So if we had a 2-bedroom unit, we're going to look at what a 3-member family's income at area median income would be, take 60% of that, back out utilities, and that's the maximum rent you can charge. So you don't have to do it unit by unit based on what the tenant earns, but you're going to first make sure the tenant qualifies, and if they do, the rent level is going to be determined based on the number of bedrooms in the unit. So the families have to earn less than this threshold income, and the threshold income is actually published by HUD. Every year they publish, based on census data, what the area median income is, and it has charts that base it on family size. So when an owner is looking to figure out what they can charge, they will go to the HUD publication, look for their particular area, geographic area, and determine what area median income is, and then they can be able to set the rents. One of the other things about this program is it encourages people to do better. So you have a family that moves in and their income is 50% of area median income, and they qualify. And then 5 years later, the family their income has gone up. And now, when they recertify, they're making more than 60% of area median income. So when they moved in, they qualified because they were below 60, and 5 years later, their income has increased, and now they're above 60. And instead of having to ask the family to leave because they no longer qualify, we have what's called the next available unit rule. And that means that the family who went over income but qualified when they moved in will continue to qualify until their income is 40% over the 60% limit. So if the 60% limit was $60,000, let's say area median income was 100, so theirs was 60, they're able to go 40% above that 60,000 before there's any question whether they qualify. They continue to qualify. If they go above that income, which I think would probably be $84,000, if their income goes above $84,000, they still don't have to move as long as the owner agrees to rent the next unit that becomes available of equal or smaller size to a qualified family. So that technically speaking, if a person qualified when they moved in, they don't have to leave and the owner doesn't get penalized for it as long as they comply with this next available unit rule. All right, so just to illustrate what we're talking about with how credits and deductions work, I want to take a hypothetical corporation who starts out with $1 million of income and $400,000 of taxes when you use a 40% combined federal and state rate. All right, they get a deduction. This deduction is $300,000. That means that their income of $1 million drops to $700,000. Their tax liability will go down by 40% of the $300,000, so down to $280,000. So that meant that your savings of $120 were equal to the deduction times the tax rate. So you had $120,000 of tax savings due to the deduction. We're going to change the facts a little bit and say that instead of a deduction, this was a $300,000 credit that the investor was earning. So now their income stays at $1 million. Their tax liability is still $400,000, but the $300,000 is a direct reduction of that $400,000, therefore $100,000. So you have a cost savings of the full $300,000. So you can see that a deduction will give you a tax savings of the amount of deduction times the tax rate. So in this case, it was $120,000. A $300,000 deduction yielded a savings of $120, but a credit is a dollar for dollar offset, so it reduced the liability by $300,000. Okay, the reality is that an investment in housing is going to generate both the credit and a deduction. So let's say for a minute that this project generated $300,000 in credits and a $300,000 loss. So if again we compare the first column to the second one, our loss did go down from $1 million to $700,000. The combined tax savings from the losses and the credits eliminated the $400,000 liability. Now, very seldom will investors reach a point where they completely offset their liability, but they can make a real dent in it, which is one of the reasons that they would invest in one of these projects. The projects we're talking about are generally organized as limited partnerships. We often do limited liability companies, which practically speaking work pretty much the same. There are slight differences. In the limited partner structures, a general partner will own 0.01%. It's a very nominal percentage of ownership, but they will be responsible for controlling and operating the project. The investor is a passive limited partner, so that means that they are not participating in the control and operations of the project. They are not managing it. They are investing equity in return for 99.99% of the ownership. The sale to the investor, the reason you want it to be as high, the maximum, the 99.99, is because the investor that will end up getting almost all of the tax credits and the tax losses, and that will maximize the amount of equity they're willing to put in. Both of these things, as you saw, have value, and the investor is willing to put money in to help get that kind of value. The more you put in investor equity, it will reduce the other financing needs, and it'll help the project get developed. You'll see later that it is potential that the equity could raise about 90% of the needs of the project. And this is because the investor is paying for the value of the tax benefits, including the credits and the benefit of the losses, and that price can end up generating enough to pay most of the costs of the project, which helps it make it more affordable. And again, the limited partner is a passive investor. It is getting its return almost exclusively from the tax credit and the losses. To the extent that there is cash flow, much of it is going to go to the general partner to compensate them for the work that they're going to do. As we mentioned, they're going to be operating the project and managing it. The partnership can pay them a fee for that, and to the extent that they do, that money will go to them. There could be a small amount that's left to go to the investor, but typically a lot of it is going to cover the fees that will be paid at the partnership level. The investor is pretty much getting its benefit from the tax credits and the losses. This is sort of an illustration of what we've just been talking about. This shows you that in the top left corner, you have the federal government, and based on some information on population, they will be telling each state how much their credits will be. The states will then determine the best way to use these credits, and they will produce what's called a qualified allocation plan, and the various potential projects will apply, and they will choose the projects that meet their standards and are most suitable to get the tax credits. They will issue them the tax credits. The tax credits, in turn, will be going to the investors. So if you look to the right, you'll see the corporate investors, the large institutional investors. These investors will be putting money in, which you see going across the bottom line, to help fund the development at the partnership level. So you see the building over here. The money will go into building that building. The building, once it's done and occupied by qualified tenants, it will generate credits. Those credits will flow through, and we see a number of people standing there. That is because many of our investors are pooled investors, so we have a number of investors who pool their money together. Doesn't have to be. It can be a direct placement by that large institutional investor, or it can be a fund of their own, so you'd only see them standing there. But many times it's going to be a pool of investors. The money will flow through to this partnership and then flow through to each of the corporations that are members of that fund. Right. Another way to look at this is you have an investor who will put their money into an equity fund, and they will own some percentage of it. If it's what we call a proprietary fund, that means that the investor is the only investor in the fund, and they're still they could do it directly, or they could do it through a fund, or the investor is one of many investors who will put their money into a fund, and let's say this investor owns 10% of the pooled investment, then they will get 10% of everything that passes through to the fund. The partners as a group will own 99% at the fund level, and the general partner, which would be Enterprise if it's one of ours, would be a 0.01% partner. In turn, that fund will invest in a number of projects, and in each of these projects, the fund will be a 99.99% partner, and a developer or sponsor will be the general partner. Again, they will own a very nominal interest, but they will be the one controlling the operations of the project, and they will be getting their 0.01%, so a very nominal percent, but they may be paid fees to manage the property. The fund will own a number of these projects. If it is a large national fund, it might have 20 investments. It might have fewer if it's a small proprietary fund, based on the amount of equity that partner is willing to invest. The syndication is what we call this, a tax credit syndication, has a number of parties to it. We have the development team, and you can see there's a number of parties that are involved in the development of the project. You've got a developer, a general contractor, the one who's going to build the project, an architect, an attorney, accountant, the property manager, and consultant. All of these are important. I'll bring up a couple that have special responsibility. Under the tax law, there are some significant deadlines. We want to make sure that the contractor is going to build a building, will be done on time. You want it to be on budget because there's usually not much room for any overruns. You want to make sure that that project has been built in a way that it will last very well for a long period of time, at least 15 years, because that's how long the credit period would be, and you would not want to have a project that needs lots of work in the 15-year period. However, you want it to last long enough that you can actually pay off the debt. So you want to operate the project for the term of the debt and whatever compliance restrictions. You want it to be well built, on time, and on budget. The property manager is also very important because they're the ones who are going to determine what the allowable rents are, and they're going to be screening the families that come in to make sure that they're qualified families. All of these parties have to understand the requirements of this program because every one of them is contributing towards making sure that the project works. The project generally has some form of construction funds in it, some sort of permanent funds, and then their attorneys are going to be working with it as well to make sure it works for them, particularly if they're using bonds. The State Housing Financing Agency is another important part because they're the ones allocating the credits. They're often one of the lenders as well. They're often going to provide some kind of state money. And then you have the syndicator. The syndicator is going to be involved with somebody who will underwrite the deal, which means they work with the developer, with the potential general partner, to figure out what the risks are in the deal and try to make sure the numbers pencil out and this deal will work. So we call that the underwriter. We have a fund manager. If you remember seeing a picture of a lot of different housing projects and one fund that was the investor, the fund manager kind of brings it all together to make sure that the goals of the fund will be met. There's usually a target return. We want to make sure that when you pool these investments, they've diversified it based on geographics and based on the kinds of projects that are in the fund. And then we have an attorney who is involved. Every one of the transactions will have its own nuances. And as part of the transaction, we have a tax opinion that will cover each and every deal. So in these cases, we've got these three people working very closely together to make sure that it all works. so there are two credits very popularly called the 9% and the 4% credit. In 1987, it was a 9 and a 4% credit. In 1987, after 1987, the rate moved some, and then eventually, in reality, it became a 9% rate. So at the 9% rate, if we were to come up with a monthly rate that would change every month, we would be at more like 7.5. But at one point, the rate became a permanent fixed rate at 9%. So it is truly a 9% credit. The 4% credit is not such a fixed 4%. It's something that is it's going to give the investor a certain return based on what Treasury bills are doing. And today, the rate is not 4%, it's 3.24. As Treasury bill rates go up, the rate will go up. As they come down, it will go down. So it fluctuates a little bit, but it's called the 4% credit because originally we had a 9 and a 4%. The rates are sometimes getting closer to 4%, but they haven't been at that rate in a long time. They're usually more like the 3.24 to maybe a 3.5%. All right, so the 9% credit, the more popular kind of credit, this is the standard kind. It covers any new construction and rehab unless it is financed by tax-exempt bonds. If it is financed by tax-exempt bonds, then unless they make an election to reduce basis, which we'll talk about in a little bit, it's going to be eligible for the 4% credit. So it's sort of a way of preventing double dipping. If you're getting tax-exempt bond financing, then you only get the lower rate. So the 4% rate is used when the project is financed by bonds. Before 2008, it also applied to below-market federal financing, but that doesn't apply today. On an old deal, you might see that, but on current deals, it's you can have federal financing and still be able to use the 9% credit. So the 4% credit will cover new construction and rehab if it's financed by tax-exempt bonds. As I mentioned, you have a basis boost, which is an increase in the credit basis by 30% if the project is located in either a qualified census tract or a difficult-to-develop area. So the qualified census tract is, again, those blocks that have the lowest income of the area surrounding it. A difficult-to-develop area is one that HUD determines costs are higher and incomes are lower. So we have higher costs, but we don't have income that will support the higher costs. Therefore, they'll give them the 30% boost. So in 2008, again, if you recall, I said that in 2008, the credit was substantially changed to make it more workable. They recognized that there would be projects that occasionally needed more money than what the project would generate, but they weren't in one of these census tract or QCTs. And they allowed the state to designate certain projects that were not in a federal area that did need to have that extra boost because they otherwise were not doable. So we call this a state-designated difficult-to-develop area where the state can take any project. However, they can't do this with tax-exempt finance. This would be those projects that are 9%. And they can designate that this project is a difficult-to-develop area based on their standards. And their standards are usually something the state has set that make them more difficult to develop. Again, there may be a particular need the state's trying to accomplish, and because there's a lack of funding for those kind of projects, they might say, okay, we think they should get the extra 30% boost. And so this would be done if it's not already in a 30% boost area. If it's not, then the state has the right to designate it. All right, as I mentioned, the actual credit rates are published monthly. So the 9 and 4, we don't use the first one today because the credit rate's below 9%. And in the event that the rate went from 7.56 and due to increasing interest rates, the published rate became higher than 9%, then you would use the higher rate. The 9% is not a fixed rate, it's the floor rate. So if the published rate went over 9%, you would use the published rate. Right now, it's at 7.56%. And then the 4% rate is at 3.24%. All right, so tax-exempt bonds I mentioned earlier, generally speaking, they're eligible for the 4% credit. And so if I have a project that has bond financing, I can't use the 9% credit. I have to use the 4%. However, the owner has an option of reducing the basis of the project by the amount of the tax-exempt bond financing and then using the 9%. So if I had a project that had $3 million of basis and there was one loan equal to $300,000 that came from tax-exempt sources, their choice would be to use the 4% credit on the whole $3 million, or to reduce the $3 million by the $300,000 tax-exempt and take 9% credits on $2.7 million. So they reduced their basis, and then they were able to use the higher credit. Now, in that case, it would be worth doing. However, let's say that the project had a $2 million basis and $1.5 million of bonds. It wouldn't be worth doing, because if they reduce basis, they'd only get $500,000 at the 9% rate. They'd be better off taking the 4% credit on the $2 million. So that's an option they have. Going to AFR is not a cure on tax-exempt bonds. If there's bond financing, they either use the 4% credit or they reduce the basis by the amount of the bond financing. So when you're using the bond credits, the tax-exempt bonds, you don't have to get an allocation of credit. So we mentioned earlier that the state only has a certain amount of tax credits that they can allocate based on the population. The bonds are not part of that allocation. There are a certain amount of bonds, a similar amount that the state has, and it doesn't have to use it all on housing, but when they use it on housing, the bonds carry the credits if you meet the test that we're going to talk about. There's no allocation, and there's no carryover allocation, which again we'll be getting into that in a bit. But you know, the rules are a little simpler. However, there's what's called a 50% test, and the 50% test says that if your bond financing exceeds 50% of the depreciable basis plus land, and we'll use an example in a minute, then you're able to use the credits on the entire qualified basis of the project. So go back to my $3 million example. I have $3 million of costs. If my bond amount is over $1.5 million, I can take credits at the 4% rate on the full $3 million. If my bonds are $1.2 million and I have $3 million of basis, I only can take credits on the $1.2 million. So I don't get it on the entire basis. Now, not many of our projects could support a long-term bond, a long-term financing equal to 50%. However, you can use the bonds as construction period financing. So our project borrows the bonds, uses them in order to pay for construction, and then pays off the bonds or pays it down to an acceptable level after the project's been completed. So then it can meet the 50% test, be able to take the maximum credit, but still not carry more bonds than they're comfortable with. Okay, the other 4% credit applies when you acquire a building. So we've been talking about new construction and rehabilitation, and there are credits that can be generated from purchasing an existing building. As long as there's a substantial rehab that's being done, there might be a requirement that there have been more than 10 years since that building was last placed in service, and there's no basis boost on the 4% acquisition credit. So if I buy a building and I pay $700,000 for the land and building, and let's say the land is worth $150,000, that means the building's worth $550,000. I can take a 4% credit on the $550 as long as I do a substantial amount of rehab on the building once I acquire it. And then once I do the rehab, I'll be able to take both acquisition and rehab credit. So the acquisition basis would generally be the cost of purchasing the building. It will also include acquisition-related costs if you have broker fees or transfer taxes that would go as part of your basis. Again, the building has to be substantially rehabilitated, which means that you're going to spend at least 20% of your acquisition cost on rehabbing the building, or $6,500 per unit right now. The number goes up every year. It was $6,000. Over time, it's gotten to $6,500. It's adjusted every year based on the consumer index. And again, unless the building had subsidies on it before and after the acquisition, the building will have to meet the 10-year rule. So it has to be 10 years since the building was last placed in service. There's no basis boost permitted, that 30% boost. And if the building is not 100% low income, then the portion of it that's qualified can also qualify for the acquisition credit. All right, we have two terms, and I've kind of mentioned them. I want to define them now. We have what we call eligible basis and qualified basis. So eligible basis is the depreciable basis of the residential rental housing eligible for credit. So basically, it is a comprehensive depreciable basis. It's not just the building. It would include the appliances, the site improvements, the parking lot. If there's a pool, the pool. The qualified basis would be the portion of eligible basis that is to be occupied by the qualified families. So you're going to back out any people that don't qualify and arrive at your qualified basis. If we have 90% of our tenants that are qualified tenants, then it would be the eligible basis times 90% would get you to qualified basis. And qualified basis is what you're going to use to compute the credits. The applicable fraction is that 90%. In other words, the number of qualifying rent-paying residential units over the total number of rent-paying. So you're going to use the lesser of the actual number or the square footage. So if you have a project that's a mixture of 1, 2, 3, and 4 bedrooms, and all of the non-low-income families, so the market units, are all the 4 bedrooms, then if you were to compare the two, the number of units over the total that are qualifying versus the square footage, your percentage will actually be lower when you use the square footage because the higher units were the disqualifying. So instead of 90%, your square footage formula might be 85% because, again, the number of the units that are non-qualifying are the larger units. So the comparable square foot units of the qualified units will therefore be lower. All right, we talk about eligible basis. To define it, I mentioned that it's sort of a comprehensive depreciable schedule of what you're doing, the depreciable items. What it does not include would be land and any land-related costs, any cost of acquiring the building other than the fact that it might qualify separately for the acquisition credit. If the project took historic tax credits, which we're going to cover next week in this session, then you would back out the historic credits in computing low-income basis. Any costs associated with a permanent loan, any sort of syndication related, any tax credit fees, these are fees paid the states to give you the tax credits. Any reserves, they're an important part of a project to make it work, but they don't count in depreciable basis. Therefore, they don't count in eligible basis. Working capital, that's just cash on hand to get started. Any federal grants, any development costs that are funded using federal grants would not count in basis. Again, it's an effort to make sure we don't double dip. So if you have a federal grant that pays for the development costs of the project, those federal grants result in a reduction in basis. And again, any non-residential costs, if you have some commercial space in your building, that has to be backed out of basis. Eligible basis excludes the initial grading to get land ready to develop. In other words, if you have to take property that's very hilly and flatten it before you can develop, that will not count in our basis because that's considered to be a cost of your land. And any landscaping that's not right adjacent to the building, because again, it's tied to the land. What it does include would be common area. So if you picture an apartment building that's got a community room for the tenants, it's got hallways, any of those would still count in basis because they're useful, they're used by the project. A full-time manager, if they're using a unit and they're living on site and managing the project, then their unit counts as common space, so it would get into basis too. And then community service facility, which is in a project that is in a qualified census tract, if you make services available to the general public right around the project so that you're serving a low-income population and it meets certain requirements for being helpful in their daily life, then, for instance, a health facility or a Meals on Wheels program where they serve meals in the actual building, and it's not only for tenants. Usually, if we make space available to non-tenants, that won't count in basis, but if it's a community service facility, it will. And we have a few slides talking further about that. Okay, eligible basis includes impact fees. Impact fees are a fee you pay to the city or the county in order to absorb your project. It might be to help cover the cost of additional schools, maybe roads that will need to be built when your population hits a certain amount. Maybe it'll be for an additional water facility. Whatever the project will need, it's usually based on the number of units, so the number of families that will be living there. But if a county or a city has a practice of charging impact fees, those will be in basis. On-site roads, sidewalks, public, and the parking lots, as long as they're serving the tenants, the parking lot. But, you know, these on-site roads, sidewalks, they're depreciable in nature, therefore they be part of eligible basis. In certain cases, the off-site improvements, which would mean you had to build a turn road to get into your project that's not on your property, but it's totally related to your property. You wouldn't have had to do it otherwise. Those can go in basis as well. The cost of hooking up to a utility, and then landscaping, if it's right around the building, and if the building were to be torn down, you'd have to replace it. And final grading of the building site. You flatten the building, now you're getting ready to put in the foundation. That will count in basis. Okay, I mentioned the community service facility. Generally speaking, this is space that is used to provide services that will improve the quality of life for the people that live around the project, be appropriate and helpful to individuals in the area of the project. What we're looking at is if you have a project and it's in an area that is a qualified census tract, meaning the lowest income population, and you provide services not only for the tenants but others in the community, they want to encourage that. And it could be a number of things. I mentioned the medical clinic. It could be a daycare center, a Meals on Wheels, or some kind of a program that will benefit the people, and it will only be available to people in the surrounding area and who are typically going to be within that 60% of area median income. The project has to be in a qualified census tract, and the people it will serve, it has to be designed in such a way that it will be serving people at 60% of area median income. The most common things we've seen have been things like a daycare center where people will pay something for daycare, but on a sliding scale basis based on their income. It could be a medical clinic where a doctor comes in once a week and runs a clinic, or more than one doctor. Or maybe it's a doctor, different kind of doctor each day, and he provides services to the people. It might be a social service provider or a network of providers. So again, there's things that will be appropriate and helpful to the individuals in the area of the project. All right, in the event that we have a community service facility, it's a pretty large amount of basis. It's going to be 25% of the first $15 million of eligible basis, 10% of anything remaining. They had to put a limit on it, but generally speaking, most of our community service facilities are well within this range. All right, at this point, I'm going to turn it over to Myra, who's going to talk about the actual calculation.
Good afternoon. I'd like to say welcome to our low-income housing tax credit program, and I'd like to thank Sue Wilson for that great synopsis of the program, and she deserves a break. So you will be hearing from me just a few slides just to let you see all of the preceding slides get you to the point of calculating your basis and your equity and your credits. So you will be able to see a simplified example of just using basically numbers. So what we're going to do, we're just going to go through like 3 steps starting out where we will estimate the tax credit basis, and then we will estimate the tax credits using a 9% rate, which is for the new construction, or the 4% rate, which would be a low-income housing, which would be a bond, tax-exempt bond deal. And we will estimate the equity for both of those so that you can see the difference between a 9% deal and a 4%. That is what I'll be presenting as the first 3 steps. So as I mentioned, the eligible basis would be basically the total cost of the project less any ineligible costs. And Sue did a great job of explaining slides 26 through 28, where she explained what items are included and cannot be included in eligible basis, for example, land, reserves, financing costs, but she did give examples of what types of grading would be in community service facilities that could be included in the eligible basis. At that point, we will take the eligible basis and multiply it by the applicable fraction, and that would be the fraction for the portion of your project that is low-income eligible. And Sue went through the 20/50 and the 40/60 test to determine how much of your project is eligible for low-income people. And as she also stated, basically most of our projects are 100% eligible. So that would be your applicable fraction, and then we would multiply it by the basis boost. Once again, this is the difficult to develop area or the qualified census tract. And once you apply those 2 percentages, we have determined our qualified basis. Once the qualified basis is determined, we'll multiply it by the tax credit rate, either the 9% or the 4%, to determine our annual tax credits. Our annual tax credits will then be multiplied by 10 since it's a 10-year program, and we will arrive at the total tax credits, which will be multiplied by the cents per dollar, which varies depending on the market, and AFR, how they calculate based on the market, really the price that an investor is willing to pay for each dollar of credit, which will give us our total equity. So we're going to do a sample project right here, just using numbers, so that we can determine how much of how much equity we can generate based off the costs. So if you assume you have a total development budget that the developer provides you for $9.632 million, you assume that you back out your ineligible costs, which are things as the land, financing reserves, And all of those costs, basically, that were on slide 26 that we consider ineligible for your eligible basis. Once you subtract those, you get your eligible basis of $8.569 million. We're assuming the project is 100% low income, and we're also assuming that the project is in a difficult to develop area or qualifies census tract, and to come up with a qualified basis of $11,140,000. Once we have the qualified basis, it's a little slow here. Okay, the qualified basis that we just calculated based on starting with a development budget of $9.6 million, backing out the ineligible costs, applying the applicable fraction, and the basis boost, we've actually increased our qualified basis to $11,140,000. We're assuming the tax rate of 9%, and we're assuming this is a new construction deal, so we have a 9% rate, which calculates annual tax credits of $1,002,000. The $1,002,000 for 10 years gives you total credits of $10,026,000. Assuming the investor is willing to pay 90 cents for those credits, you generate equity of $9,023,000. If you remember a few slides back, we started with a total development budget of $9,632,000, which is on slide 36. Maybe I can get there real fast just to show you that the total development budget was $9,632,000, and then when we get to slide 38, the equity generated is $9,023,000. So basically, using the 9% credit, the equity we generated here based on the credits and the price, we have generated 93.7% of your total development costs, which is a pretty good deal. You don't have to come up with a lot of extra other loans or capital to complete your project. We're going to look at the same example as if this were a 4% or a tax-exempt bond deal. We start with the qualified basis that we generated based on the basis boost and the applicable fraction of $11,140,000. We're assuming the tax credit rate for March 2017 of the current month, which is 3.24%, which calculates into an annual credit of $360,947 annually, but we know it is a 10-year program. We multiply it by 10, and the same price we're assuming the investor is willing to pay of 90 cents, and we generate equity of $3,248,526. Now you can see the difference here. This equity for a 4% tax-exempt bond deal, the equity generated only represents 33.7% of the total development cost, which was $9,632,000. So we're going to assume a sample project real quick just to take you to the finish line of what we go through all of this for, and to see how much a mortgage you could get, and then we'll discuss some of the different programs to complete the funding gap once we've calculated our basis and equity and the mortgage amount. This is a real simplified development budget that the developer would supply to you, and I've kind of just grouped it as acquisition costs, construction costs, including your furniture and fixtures, and then any soft costs that would be charged. Of course, your developer is going to be paid, so his fee is shown. And then the bottom section, more or less, where the remaining half is basically costs relating to your mortgage, of title and recording costs, any legal costs, and basically a few other additional soft and hard costs that will be required. But this total represents the number we've been working with the past couple slides, starting with a development budget of $9,632,000. And what we have done here is broken it out between the 9% and 4% deal. In this case, we're assuming this project is an acquisition. It's an acquisition of a property, but we're doing a rehab of the property. The two examples we discussed before was simply a straight 4% deal, which was a tax-exempt bond deal, and a straight 9% deal, which was new construction, and we calculated the equity separately between the two to show you the difference in the two. In this case, we're assuming this is an acquisition rehab deal combined. So we have acquisition costs in this column, anything that pertains to the acquisition of the property, which you can see the very first line, the acquisition cost of $500 or $5,000 has been broken out into building and land. So basically, all the costs that pertain to acquisition are going to be split pro rata the same way. So just one example, let's see if there's a cost here. Looks like we've kind of just taken them and broken them out. Like I said, this is a simplified budget, but basically we have all the acquisition costs in column 3 here, all of the 9% costs that relate to the new to the rehab in column 2, and then column 4 are costs that would be amortized or expensed or non-depreciable costs like land and reserves of $185,000 are non-depreciable. Your tax credit costs are non-depreciable. Your marketing, basically, all of these items are non-depreciable costs. So the final bottom line shows that you have 9% basis of $8,569,000 and acquisition basis of $454,000. At this point, we are going to now calculate what the credits would be on the rehab portion of the building and the acquisition portion of the building. The rehab portion that was shown on the previous slide was $8,569,000. We're assuming, once again, it's 100% low income. We're assuming it does qualify for the basis boost. And at this point, we've calculated basis of $11,140,000. The credit rate for rehab is 9%, which calculates annual credits of $1,200,000. So that's just based on the rehab cost out of the budget. Since this was an acquisition rehab, we have to calculate the acquisition credits based on the rate for the acquisition basis. From the previous page, the acquisition basis was $454,000. The March rate for the acquisition of the property is 3.24%, which generates annual acquisitions of $14,710. So the two numbers to pay close attention to here are the annual rehab credits of $1,200,000 and the annual acquisition credits of $14,000, which we will. Oops, went too far. Which we will add those two together to show that the total annual credits that this project can generate is $1,017,000 based on the rehab portion and the acquisition portion. Once again, the properties or the credit is a 10-year credit. So in 10 years, you will generate $10,173,000 of credits. And for these purposes, we're assuming that we're paying 80 cents from the investor, 80 cents per dollar of credit. Each project, the price varies, and in this case, using 80 cents, we're able to generate equity of $8,138,728. So we're going to compare that equity. Further down, you will see that we're going to compare that $8 million to the total project cost of the $9 million. We're going to show how much of a gap that you have from the total cost less the credits generated, the equity generated from the credits less the first mortgage that you could generate from a property of this size. So this is just basically your basic operating pro forma, and Sue spoke about the gross rents and the utility allowances and the 40-60 test and having to limit your income to 30% of the area median income or the threshold income for the area. So this is just a simple project. We're assuming it's a 100-unit, 1- and 2-bedroom project. And just for examples of for this example, we're assuming the gross potential income is $555,000 that would be able to be generated for the year. We've reduced it by a vacancy of 7%, and we're assuming that we'll reduce the effective gross income for the expenses. We're estimating at $100 per unit, and the expenses are $3,800 per unit because we have 100 units, and the replacement reserve is $250 per unit for the 100 units, which we reduce the effective gross income by those two amounts to get our net operating income of $111,000. And we're going to divide that by a 1.15 debt coverage ratio, which is generally a requirement from your mortgage lender that you cover your payment by at least 0.15, or sometimes it's a 1.1% coverage ratio, depending on the mortgage program. And in this case, this says out of the $111,000, you would be able to service a mortgage payment of $96,000 per year. If we're assuming that it's going to be a 30-year amortization and an 8.5% loan, the constant for these terms is 0.0955. So if you divide the $96,000 by the constant, it would generate a mortgage of $1,012,000. So this is now showing you how much, based on the cash flow and operating expenses and any any replacement reserve funding, that you would be able to pay a first mortgage amount of $1,002,000. So here's our summary. We started with a total development cost of $9,632,000. We estimated in step 3 that the equity, based on the 4% and 9% credits in total, we would generate $8,138,000 of equity based on the 80-cent price that the investor was willing to pay. And we just showed in the previous slide on page 45, or slide 45, step 4, where we would be able to service a mortgage of $1,012,000. So if you take your total cost less your equity less the first mortgage, it shows that you have a gap remaining of $481,000. At this time, Sue Wilson will return and explain how this gap can be covered. Thank you.
All right. Basically, there are a number of ways that a project could use to help cover this shortfall that we just identified of about $481,000. This is probably one of the toughest things the developer has to do, is to find the sources to do that. So some of the things that we could do is we could look to some government sources to do this. I'm actually going to go forward one slide that tells you a little more specifics. Some of the government sources could be home and CDBG funds. Many states have this as a source of funding gaps for rental housing. Those programs are used for other things as well that support similar programs, but the states or the counties or the cities may have some of this money that they can help towards the project. The Affordable Housing Program at the Federal Home Loan Bank is another gap filler. This is a group of banks that together will put some money in, and those can be, usually they're granted to another bank or to a sponsor in order for them to make a loan or a grant to the project. So those work. I mentioned federal funding. A grant of home or CDBG to the project as opposed to a loan would result in a reduction of basis, which can make the numbers not work. They may be okay, but they may not be. AHP funds are private money because it's funded by private banks. So you could bring those in as a grant to the project. It would still generate income, but there's ways of avoiding the income by using a nonprofit partner. ARA funds were available earlier in the 2008, 9, 10. We've still seen a little bit of those funds still available in our projects. This is called TCAP and exchange money. You probably aren't going to see any more exchange, but you might see some TCAP that's residual that didn't get used by another project. And you might see a little bit, but those are federal funds, and we have to be careful how they come into the project. A lot of times the cities have some other local funds, or it might even be something like a utility company. Sometimes you might find a utility company will help a project if they're raising some of their equity is going to cover things that will make the project more energy efficient. Or if you're serving a very low-income population and you're covering their utilities, then the local utility company may be willing to give you some kind of a subsidy or an infusion of cash to help you with those costs. Some projects have what's called a deferred development fee. Usually the development fee, which is an upfront fee used to compensate the developer for the work they do. To the extent that you can pay it out of the equity that's being raised, the money that Myra showed being raised from the credits, that's good. But to the extent that there isn't enough to cover it because of the shortfall, then the developer could be paid after the cash flow that is used to pay the first mortgage and reserves. That 15%, she said you had to get to a 1.15. That still leaves a little bit of cash. The developer could, in essence, leave some of their fee in that will then be paid out of the cash flow. And hopefully they're going to try to do better and generate more cash flow than the projections show. And that's going to help them get paid their fee a little bit earlier. There can always be cost savings, either on the development or the acquisition. But that's one that I caution people on, because cost savings on the acquisition means you actually go back to the seller and try to get them to sell for a little bit less, and that's good because that gives you a little bit more to work with. But it's not so good when you're working development. If you can cut your development costs in a way that doesn't hurt the quality or the ongoing maintenance, then that's fine. For instance, I mentioned the utility company. If you're able to get them to cover some of your costs, or if you're able to cut the budget in some way that it really won't impact how your property performs, then that's a good thing. But when people try to cut costs and they do it just in an effort to cut costs, they're not paying attention to what the maintenance will be. Sometimes it just results in additional maintenance, or sometimes it just results in overruns. We've cut the budget, but the reality is this is what it costs. So we have to be very careful when cutting development costs, but if done wisely, it can work. If you're able to get the county to abate the taxes that they were going to charge during construction, that's a good savings, and that won't increase any operating expenses. But if you cut the quality of materials or you cut corners and you shouldn't do that, that's not a good way to save. You could go back and modify the first mortgage terms. If we looked at this one here, you've got an 8.5% return over 30 years. Well, that's an awfully high interest rate. Today, you might be able to get that rate down some, but it could be that you entered into an agreement where the bank put a higher rate on it because they thought that interest rates were going to go up. Well, interest rates didn't go up that much, so you may be able to get them down a couple percentage points. Or you may be able to get them to stretch out the amortization. Instead of using a 30-year term, maybe you use a 40-year term with a 30-year balloon. And after 30 years, other debt can be paid down so that you'll have the ability to refinance. Income and expense modifications is another one. You could go in and look at your income and expenses, but again, being realistic. If you think you're at the lower end of the market, could you increase your rents by just a little bit? If you're not at the lower end, then it's not a good thing to increase your rents because you can end up having a little more vacancy. So that's not a good thing. Expenses, again, you don't want to cut expenses that in fact will end up being generated. If you're able to get an abatement of taxes, that's great, because that, again, is a real savings that you'll experience. If your insurance rates, if you're able to go back to your insurance broker and work out a different rate or use a different company and it doesn't increase your risk, that may be a real savings. So, again, for income and expense, we want them to be a real and achievable savings, not one that you're not really going to realize. We're going to talk a little bit more about some of the special rules when you're dealing with the tax credits, and then we'll be talking a little bit about energy credits. So first of all, I mentioned there's some deadlines, and we have to be aware of what these deadlines are. If a project gets an allocation, then one of the requirements is that it must be placed in service by the end of the second year following the allocation year. So for example, if we have a project that received its credits in 2016, they have to meet what's called a carryover test some date in 17, whatever it's been designated to be, but no more than a year after they got their allocation. And they have to be done and placed in service by the end of 2018. So they got their credits in July of 2016. They have to be done by the end of the second year following the allocation year. So that gives them until the end of 2018. Even if they got their credits in January of 16, they still have until the end of December 2018. So it's based on the date you got the allocation, 2 years, and then you have to the end of that 2-year period. All right, so the definition of when a project's in place in service is going to vary based on whether it's new construction or whether it's rehab. If it's new construction, it is when the first unit is ready for its intended use. Ready would typically mean you have the right to occupy it. On new construction, that would mean you have a certificate of occupancy. The reality is that very few buildings can you get a certificate of occupancy until the building is done and ready to be rehabbed and safe for tenants. But the technical definition is one unit is ready. So if you can get the right to use the one unit, then the whole building is deemed placed in service. But if you cannot get it, the fact that you have the one unit ready, but if the tenants cannot use that, you cannot bring anybody to use that unit because of the other work going on, and you can't get the right to occupy, then you're not placed in service. The reality is that in most cases on new construction, it's when your building is really done. For rehab, there's more flexibility. The date you select for rehab to be placed in service is the date when the rehab equals the greater of $6,700 per unit. I think earlier I said $6,500. It's gone up to $6,700 over the years. So it increases every year based on what the consumer index is. So at this point, it's the greater of $6,700 per unit or 20% of the acquisition price. This is determined building by building, and although the project got one allocation, the place in service is determined on a building by building basis. So you have to look at the allocable acquisition cost and then how much your cost per building was and how they compare, the greater of the two numbers. It doesn't mean that your building is actually done, and sometimes we elect the place in service knowing that we have more time to actually complete the building, but it allows us to meet that deadline of the second allocation year. And another thing is we keep talking about how money comes in and whether it's a grant or not. And I want to distinguish between debt and grants and how it makes a difference when you're structuring a project. Okay, we have what we call hard debt, which is must-pay conventional bank debt. If you don't pay, the bank has the right to take the property. Generally, it's amortizing, and generally we're going to limit that debt, the amount of that debt, to what the project can comfortably afford, because a foreclosure of the property is the biggest risk you have for losing the tax credits. If the project is foreclosed upon, the owner will end up losing the tax credits they got and having to recapture them. Soft debt is also referred to as contingent or accruing debt, generally coming from a governmental agency, and the payments are going to be cash flow or contingent, meaning if you don't have the money to pay it, you don't have to pay it. It just continues to be added to the loan balance. But in all circumstances, it has to be repaid in order to make sure it's a loan. The distinction is that a grant is there are funds that are not repayable or that you can't reasonably repay. So if there's money that comes into your project and there's no ability for the project to ever pay it, that looks more like a grant. And grants can create some problems, so we're going to talk about that. All right, so grants are the funds that are either not repayable by the terms or cannot be repaid under reasonable assumptions. In other words, if you have reasonable assumptions as to how income could trend and how losses might trend, and you can't repay the loan, then that amount would be deemed to be a grant. An outright grant means the terms of it say you never repay it under any circumstances. Forgivable loans might look like a loan, but there are terms that say if you do certain things that you will be doing as the owner of the project, like keeping it affordable, then you don't have to repay it. We'll start forgiving it. Then that's a grant up front as well, because you're already agreeing to make this a low-income property unless these terms are above and beyond what you're already making. If there are forgiveness terms, it's considered to be a grant from the outset. And the last would be if at the maturity of the loan, even using some more aggressive kinds of assumptions, but reasonable in nature. So when we do our base numbers, we trend income at 2% and expenses at 3%. But it's realistic you might be able to trend rents at 3%. So if we looked at a 3% trending of income, 3% of expenses, could we pay it off? So if you can't pay it off, then the portion that you can't pay off is considered to be a grant up front. Even though the measurement isn't until the end of the maturity date of that loan, it still would be considered a grant. Now, the tax treatment of grants is important to consider. First of all, grants generate income. And so we said that investors get losses, and although they're not buying the losses, it does give them a benefit. Income counters that. If they have to pick up income up front, that lowers their return because it lowers the tax benefits they're going to receive, and they're going to pay less for their equity in the project. If the source of the funding is federal, either directly or indirectly, then that's going to not only result in income recognition, it's also going to result in a reduction of basis. Now, one of the things that a partnership can do to avoid the income recognition is to have the money flow through a nonprofit partner who will make a capital contribution. That gets rid of the income, but it doesn't get rid of the basis reduction. If the funds are lent to the partnership from a federal source and we can show that we can pay it, then that gets rid of the basis reduction. All right, now we have a distinction between development grants and operating grants. Development grants are what we're referring to that can result in a basis reduction. These are funds that are used directly or indirectly to fund development costs. So in that case, if you have a development grant that is from a federal source, the basis has to be reduced. However, as I mentioned, you could have the money come in not as a grant, but you could bring it in through the general partner as a loan. Today, we don't have to worry about the interest rate on that loan. You can use a very nominal interest rate and still have it respected as a loan, as long as you're able to show that you can repay it. And you also have to be aware that there could potentially be reallocations when you start bringing money in through the general partner. That would mean that losses could end up going to the GP and therefore the credits, and it's just something to be aware of. It's beyond the scope of this program, but it's something to be aware of. When you're using money that comes in through the GP, there could be some consequences to it. After 2008, the rules changed a little bit dealing with operating grants. And operating grants are funds that come in that support not the development of the project, but the operations of the project. So this means that the project is up and running, and now we're bringing money in because our utility costs are much higher because we've had bad weather, we've had extreme hot and extreme cold, and our utility costs are higher than we envisioned, or there is some kind of a natural disaster and certain costs have increased, operational costs, maybe insurance. So you go and you get some sort of subsidy. It might be because you have a special needs population. It might be through a utility company. So you bring in some money that is not going to support the development of the property. It is going to support its operations. And if that's the case, then you still have to recognize income because it is a grant, but there's no worry about basis reduction. All right, a couple other things. Historic tax credits. This is something we'll be discussing in the next session, but basically these are the credits that you can generate when you rehabilitate an older property that is historic in nature, and the credits it generates do work with the low-income credits. It can work very well, and it can help fill a gap for sure, but there are some rigid approvals and procedures that you need to follow, and it can be more costly to the deal. When you're talking historic credits, they're going to require you to do certain things that maintain the character of the historic nature of the property, and that can be costly. That being said, if the decision to use historic credits is made early on, those additional costs can be incorporated into the rehab budget, and they won't be so bad. It does reduce basis. So when we talked about the eligible basis and we said certain costs are reduced to get to what we compute credits on, the historic credit is one of these. But it's still, it is a gap filler that can be very helpful where it applies. We're also going to talk in a little bit about some energy credits and things that are green subsidies that make your project work better if you follow environmental recommendations. And these kinds of credits can also be a good gap filler where they're used with an affordable housing project. Another thing that's a consideration that you're hearing even more of today are special needs deals. And these are deals that are serving a special needs population. And there's often some kind of subsidy that is either by the state government or the federal government that will help cover the additional costs, like the services that you need, or it might be a rental subsidy that not only covers the rental but may even help cover the operations of the project a little bit. And again, it's because you're serving a special needs. The big concern with these special needs subsidies is that how long will it continue? Will the government potentially cut it? They historically have not cut it, and investors have gotten comfortable that if we're still serving that population, they will continue to provide that subsidy for the existing projects and not cut it. They may not do additional projects but that will provide the subsidy, but many believe that if the project is already in operations, they're not going to cut the subsidies, but there's no guarantee. You have, in most of these cases, a year-by-year contract. Historically, they've been renewed, but you never know if they are. And when underwriting a deal, we make some assumptions about what happens if we lose the subsidy, what rights do we have, and what can we do to make the project feasible. All right, at this point, we're going to move on to federal energy credits. But I think before we do, we were going to stop and take some questions on the low-income side. And Donna, I'm going to take it back to you.
Okay, certainly. Yes, we've gotten some great questions in while you were speaking. And let me pull them up so we can sort of take them in the order that they arrived. Okay, question 1. In order for all units to receive tax credits, does your threshold have to be 100 over 60?
100, yes. If you want to take the credit in all the units and you're electing to keep that set aside, then all of your units, if you're going to take credits on all of the units, all of them have to be at 60% or below. Now, I talked about if an existing tenant goes over income, there's some special rules, but they at least had to qualify when they moved in.
Okay. Where is qualified designated census tract information located?
They're published by HUD annually. Usually it comes out in the first quarter of the year for that year. Sometimes it might come out late fall, but often that information is published sometime in the first quarter. But it's published by HUD, not by the IRS. The IRS puts it in a notice, but it's HUD's announcement that publishes it.
Okay. And this next question is in reference to slide 21. Is the basis you are referring to the same as the basis that is on the limited partnership's tax return?
The basis. Okay, this is the 50% test of depreciable basis plus land. It would be the tax basis. Generally, it's going to be the same as is on the tax return. There might be times where the accounting book numbers are a little different than tax, but generally speaking, yes, they're going to use depreciable basis plus land off the tax return.
Okay. Next question was from slide 24, and that is, how do they determine what amount of work is substantial?
24. Okay, so this is in relationship to, I don't see anything on 24, but I'm thinking it's the substantial rehab, and the definition would be that it's the capitalizable rehab cost of at least $6,700 per unit, or 20% of the acquisition price of the building, the greater of the two.
Okay. Next question is, you mentioned that a family who earns more than 60% of AMI can stay in place until they are earning 40% more than 60%. Even once they do exceed that threshold, they can stay in place due to the next available unit rule. Do they still pay below market rent?
If the project is 100% low income, then yes, they're still going to pay the subsidized rent. If they increase the rents when the next available unit is occupied, if they increase the rent, then that unit will no longer qualify. So if the project wants to stay at 100%, they will always rent the next available unit, but they have to continue to rent restrict all units. So unless the project is mixed income and they can basically trade the units and say, now this one will be a market unit and the other will be low income, typically if we're at 100% low income, all the units need to continue to be rent restricted. So the person going over income will continue to get the rent restricted rent, the lower rent.
Okay. Are county grants excluded?
County grants are still grants, and county grants, if they come in as a grant, will generate income. If they come in as a grant, we have to look at the source. If the county is using federally sourced money, such as CDBG or home, then it will also come out of basis. So you don't look at who the actual grant comes from, you look at the ultimate source of the money. So, and if it's not coming from a federal source, then it doesn't reduce basis. So if it's county money from the imposition of taxes or whatever, then you still pick up income if it comes in directly to the partnership, but you don't have to reduce basis. If it's coming in and it's from a federal source, you have to reduce basis too.
Okay. And looking for a clarification, so acquisition credits are only applicable to improvements, whereas other tax credits are applicable to land as well based on the 50% test? I was under the impression that tax credits are never applicable to land.
Tax credits are not applicable to land, that is right. The 50% test is a test that compares the actual financing to the eligible basis plus the land. It's only for purposes of determining if you used enough bond money. You're not computing credits on that number. The acquisition credits is on the purchase price of the building, if the building qualifies for acquisition credit, which we mentioned You're going to do a rehab of the building, and it's been 10 years if the 10 years are appropriate. For the rehab or the new construction, it's the rehab basis or the new construction basis. You will never be able to count land to compute the credit itself. It's only for purposes of meeting certain tests that you included.
Okay. Could an agency's administrative offices qualify as eligible basis if community services are delivered out of the location?
Okay, so if the sponsor's offices are used solely to provide services and you otherwise meet the test for community service, that will work. If the agency moves in and uses that as their headquarters, and sometimes they provide services out of part of the space, that will not be a community service facility. It will only be a community service facility to the extent that they are providing services to the surrounding community. So again, if it's their headquarters, that doesn't count, but if their offices are used to deliver social services, usually that means the headquarters is somewhere else, and they just have a branch office that does social services.
Okay. Hit a couple more questions and then I think we'll need to move on to your next segment, but we've got two more here. Do most developers use a consultant to go through the state application process? Can you go it alone? How do you find the right person at your state to get applications, deadline dates, et cetera?
Okay. If you're a sponsor that is asking the question about how do I go through the process and meet the deadlines, et cetera, you probably do need a consultant the first time or the first couple times. Developers do it on their own if they have the capacity to do it on their own. They will use a development consultant if they need to bridge the experience of that consultant to what they have. In other words, if they're not familiar with the agency's requirements and what it takes to get a good application, then they should use a consultant. If they're not familiar with how to raise the best equity, they should use a consultant. If they are familiar, like they've done 4 deals and now they're comfortable, then they no longer need the consultant. So yeah, developers can and do it on their own.
Okay. And last question for this segment. So if you have an existing daycare situation, how would the eligible basis be computed for that? On construction cost or some form of tuition or income?
No, it's going to be on the development costs of that part of the building. So you're going to build out the daycare section, and your cost that you spend on that, you would do your measurements and determine they qualify, and that would get added to basis. The income part of it is really to determine that it qualifies as a tenant, as a community service facility. If you're using the daycare and charging market rates and everyone has to pay the same amount, or you're serving the general public and not the affordable housing population, then it won't qualify. But a daycare that is operating and designed to benefit the people that live in the surrounding area and people pay based on what they can afford, that will probably qualify. So again, it's more than just providing a daycare center. If it's a for-profit daycare center, it probably won't work. It's got to be something that is affordable to people that are below 60% of area median income.
Terrific. We've got a few remaining questions, but we're going to take those at the end of the session with the rest of the Q&A questions at the end. And with that, I'll turn it back over to you.
All right, so we're going to move on and spend a little bit of time talking about energy. Unfortunately, much of what I'm going to talk about, these credits have expired, and we're just going to basically describe them. We're going to start with just sort of an overview. We're going to talk about solar credits, which is one that is still being used. It is still valid. And some of the others, which are fuel cell turbines, geothermal, and then the energy efficient home credits. So these are the different ones that we do have, many of which expired at the end of 2016, and there are questions to what extent they'll be renewed. All right, so the federal energy credits, to qualify for these credits, the original equipment must begin with the taxpayer. You cannot acquire somebody else's solar equipment and take the credit. The original use has to begin with the taxpayer. The credit is generated in the year that the property is placed in service. So again, you install, and as soon as you've got the right to operate it, the credit is generated. There are federal credits that we're talking about here, but you will also find that there are several states that have similar programs if you're showing energy savings. So energy savings is sort of an initiative. Some states have grabbed onto it better than others, and these programs were in the federal government, and what you're going to find is some of the credits are actually not used as much as some of the others because of the cost involved, and the credits are not enough to make it efficient. Let's start with the solar energy. This includes equipment that uses solar energy to generate electricity or heat or cool. Sometimes it is providing the electricity for our specific project. Sometimes it actually produces energy for our project and makes additional energy available to the utility company. The credit is equal to 30% of the eligible costs. There is no maximum credit, and this would apply to projects. The 30% rate will apply to a project if they started construction by the end of 2019. After 2019, the rates will start going down, and eventually, after 2021, the rate will be 10%. There is a lot of interest in extending the 30% further, or not having it go all the way down to 10%, but perhaps getting it to stabilize at more like 20%. It's a little bit hard to predict right now because of the nature of the tax reform time that we're in right now, and this would be something that would need, in order to do this, there would have to be something else in the law that isn't. So perhaps if none of the other energy credits move forward, we may be able to see some flexibility, but there's no push for it right now because the rate will be through the end of 19 and then a little bit longer with transition rules, and then the reduction in rates is kind of gradual at first. So it's not on the highest list of priorities to extend these rates. It's on people's minds, but it's not the highest priority because we have more time. The energy credit, the solar credit, can be used with other credits or it can be used alone. We've seen some pure solar energy projects. We see a lot of solar energy coupled with the low-income housing tax credit. So fuel cell credits are devices that will generate electricity by chemical reaction. And this is a credit equal to 30%. There's no maximum, but it is limited based on the energy it produces. So you've got the limitations are not just eligible basis, but you have to show how much energy this produces, and if it doesn't produce the requisite energy, it may not be the full 30%. All that being said, this is currently expired, and it is not one of the credits that's being really touted as a high priority for trying to extend it, but if there is a general extenders, it might be extended. Wind turbine is a device that converts kinetic energy from the wind into electrical power. Now, one of the things about this credit is you're using something that is a renewable energy because there's always going to be some wind. And this is the kind of credit that if something were to be extended, we probably would see this being extended because it is using a renewable source. It isn't something where you've exhausted the source, and it isn't as costly as some of the other things that we will be talking about. These are some examples of some wind turbine, and you can see you've probably driven by some of these when you're going through some of the rural parts. But again, they're taking the wind and turning it into energy, and that's always a good thing. Microturbines are, again, they're wind turbines with up to 2 megawatts in capacity. Their credit is equal to 10% of the eligible cost, no maximum credit, and this is available for systems that are placed in service again by the end of 2016. It is currently expired. Again, it is using wind, but this is a lower credit, and it's not getting as much of a drive for renewal because it is not as big of a credit. I think there could be a push to try to get if this were to be extended, try to get it to be a higher rate. Geothermal is an interesting one because, again, you're using heat from the ground and you're using it to produce energy. The credit is 10% of expenditures. And, again, this is one that is expired. This is one that is a little bit controversial because it is an important credit, and the properties that have benefited very well from it. However, it's not a particularly high credit, and it is a very expensive investment they're making. So unless the credit were to become higher, we would probably not see much use for the credit. The credit did not get much use during the term that it was being operated. It was used in the parts of the country where utility costs are very high because of severe winters, and to the extent that they could use them, although it was an expensive investment, they still produced enough savings that the credits were just one little part of it, but it was worth doing. Generally around the country, it did not get much use because of the high cost and the low amount of credit that it generated. These are some examples of geothermal, where again you can see that what they're doing is digging into the ground, bringing up some of the energy from the heat that is further into the ground, and this heat reproduces. It's like you bring it up and it will reheat. And you can see that it will be used then to provide power to the surrounding area. So it's a good thing in thought, but these investments of the kind of infrastructure it takes to do it are very costly to put in and to operate. And if the program were to continue, it would probably need a higher credit rate. On the combined heat and power, the eligible property includes systems, and this is a little bit unusual because the system has to show some energy efficiency, and you're going to get 10% of your cost. However, the credit rate goes down if you don't show as much efficiency. So this is actually a credit that is a little bit flexible. It can be used if you produce less savings than 60%, you can get a reduced credit. And you just have to show that certain kinds of energy efficiency occurred. So it's a more flexible credit than some of the other credits that we've been looking at. Again, this is currently expired. There's questions whether or not it will be renewed on its own. It's probably not got a great chance, but if it's part of a general extenders, then it might. The energy efficient home credit is probably the one that has gotten the most notoriety. This is a credit for newly constructed or rehab that meets certain energy saving requirements. So when a person is building residential housing or property that's going to be used for residential use, if they can show that their energy consumption will be at least 50% less than a similar unit because of the things they're using to do it, it might be insulation, it might be better windows, whatever, then they're going to be able to get a credit. This is a credit that applies to owner-occupied or rental housing unit. The credit is $2,000 per unit. We see it in affordable housing. Some of our properties will generate it and the investors will pay for it. In other cases, the developer might take the credit if it's appropriate and we let them take it. It's a way to help them make the property more efficient. This is a credit that is currently expired. This was probably one of the most commonly used credits. The construction industry is fighting to keep this one alive, to bring it back. So this is one where there's a hope that we'll bring it back. it has really produced good results because in order to get the credits, you need to do things that are going to make the energy consumption much lower than other properties would do. So this is a win-win situation, and I think you're going to see a big push to try to get this one back in. All right, so what I want to do now is sort of talk about what's going on in the affordable housing business and the related business as far as tax reform and other things. So as you know, we had a change in the administration coming into this year with a new president, and you've got a group of people who have been saying for a while they want to do tax reform. Tax reform typically means looking at our system, finding ways to make it more efficient, and in this case, simplification as well. If we can make it more simple, then it would probably be easier from a compliance standpoint, and many people don't like some of the extended rules and regulations and all these different rules you need to follow. One of the goals of tax reform is we just won't have all those rules. We're just going to simplify things and move on. So the House is currently working to translate tax reform, the blueprint that they designed, into legislation, and they are predicting that we will see their first draft of legislation coming out sometime this spring. One of the goals of the legislation would be to drop corporate rates from the current maximum of 35% down to 20%. So 20% is where they'd like to get. Cutting the tax rate in order to not hurt the federal budget means that you would then have to make, if we're going to cut the tax rate, we're also going to have to cut some deductions. So cutting the tax rate, we'd have to cut some deductions, but there's also the theory that if there's more disposable income, they will reinvest it. And some of the things they are talking about would be to encourage reinvestment. So, you know, the tax rate drop would have an impact that we're going to come back to. The tax reform blueprint did not mention anything about housing credits and housing bonds. It was silent as to that. That being said, the House has said that they are very supportive of the low-income housing credits and continuing the system that we have today. The administration has proposed lowering top corporate rates even further to 15%. We haven't seen the details of what that will encounter. In other words, what deductions will we lose, or what is the benefit of going down to 15%. The Senate actually had some proposals, but there's been sort of a start over on it, and they have a tax reform proposal which we will probably see late summer. The prediction originally had been in June, but because other things that are higher priority than tax reform are taking longer than they thought, it's probably going to be late summer or even a little bit later than that, but sometime this year. So what is the impact to us when we're looking at the housing industry? Well, first of all, there's the potential for threats to key programs, but there's also some potential opportunities. As we talked about, the elimination or substantial reduction, this could be a result of a number of things. Recently, we've heard of the budget, and the budget and tax reform do go together. And one of the things in the budget would be to cut some of the housing subsidies, the new subsidies that might come about. And the reality is that on much of our projects, we do need those subsidies to make the projects work. So if we were to eliminate or substantially reduce some of the programs that provide subsidies to the projects, it can make it more challenging to do the kind of projects that we want to see done, the ones that serve lower income populations, the ones that serve special needs. So the funding cuts can have an impact on that. In addition, they can make it, the potential threat would be that it could make what we're doing make it less effective. In other words, we could produce units of housing, but a couple things that could affect it is that some of the potential changes are going to make it harder to make some of the projects work. One of the things they're talking about is eliminating the 4% credit for bonds. Well, the 4% credit for bonds is a substantial amount of deals, and those deals are typically ones that provide some mixed income opportunities. And eliminating those programs could have a dramatic effect. Another thing that there's been talk about is we take the credits over 10 years, but it's a 15-year compliance period. Why aren't we doing it for 15 years? That's one of the questions that has come out of reform. On the other hand, there have been suggestions that we make the credit period shorter, that we still have the 15-year compliance, but maybe we should make it shorter. So it's a little hard to tell where reform will go, but it can, the big concern is that, are they going to make changes to the program that will make it more difficult to make the projects work? The one our biggest concern is in the drop in the corporate tax rate. As we mentioned, as we've been talking today, investors buy credits, but losses come with it. Investors are driven by return. If they invest in a project and get a 35% tax benefit for $1 of loss, then those losses become more valuable and drive up their return. If the tax rate were to change and it would drop to 20%, 15%, we don't really know. 15 to 25% is what people guess. But now these losses become less valuable, and investors are going to pay less than the equity prices they're paying today, or they have been paying, because some of them have already dropped the rate in the formula. When the announcement that they wanted to drop the rates to somewhere between the 15 to 25, the rates that corporations were paying on deals dropped somewhere between 10 to 20 cents per credit dollar. That makes for less equity going into the project, and on top of that, you're talking about other potential cuts that can make the project harder to do. If you go back to the example that Myra had, if you cut the equity and in some cases you cut some of the subsidies that were coming in, it makes the project difficult to do. So we said that there's potential risks. There's also some potential opportunities. Well, first of all, we're going to talk in a minute about a potential bill that is still moving forward that might expand and extend certain provisions of the program. In addition, although the tax rates might go down, there is some discussion about somehow protecting the housing credit program by maybe increasing the credit rates, or again, maybe taking them over a shorter period of time, or there's even talk about, well, we really want to encourage development if we allow new expenditures for rehab and new construction to be expensed or to be depreciated over a very short period. Although the tax rate's lower, the benefits are front-ended because those deductions would be early on. All of these are things that are potentially discussed. We don't know what's going to be in tax reform. You've got three different sets of groups that are producing tax reform. Somewhere in the middle will be what kind of reform we're going to get. We don't know what it's going to be, but there's a lot of discussion that provides threats, but there's also some discussion that provide opportunities. All right, so I want to talk a little bit about the Cantwell-Hatch bill. Cantwell and Hatch are two big supporters of the housing credit, and they introduced last year and then reintroduced earlier this month the Affordable Housing Credit Improvement Act. And this act would do some things that would make the credit easier to use and, in fact, expand the amount of credits. So some of the deals that are harder to do, if we can give them more credits and use up all the potential bases they have, the deals may be more doable. So some of the changes in this bill, okay, one of them would be to increase the annual allocations that the states get by 50%, which would be phased in over a 5-year period. So instead of being that number that we had earlier in the slides, which I think was $235 per capita, instead of being, 235 is this year. Instead of being that rate, it would basically go up over time by 50%, so we'd have a lot more credits in each state. Another thing is, as I mentioned, that the 9% became a permanent rate, would be the minimum rate, unless if the published rates are below 9%, you use 9%. If it goes above 9%, then you use the published rate. But they didn't do that to the 4%. One of the other changes would be to go to a 4% minimum on both bond deals and acquisition deals. Another thing would be to go to rural and Native Americans and find ways to make the facilitation of housing in those markets more achievable. These are markets that no matter what we've done in the tax law, they're harder to serve, and maybe we come up with another way of motivating people to do these deals. Maybe you give an additional tax benefit to those projects that are in these particular areas. Another thing that they're talking about doing is to do what's called income averaging. And income averaging would mean, if you go back to what I told you earlier, where we said that you've got people who are below 60% in order to qualify. What if we said that 20% of your people could earn up to 80 as long as 20% are set aside for people below 40. Overall, we're still at the 60%, but now you've opened your market up, and for those people who were at 40%, they're able to pay a lower rent because of the rent that people are paying at 80. So this is something new. The idea is that, again, we're going to be able to open the rental market up to people earning above 60 and use them to subsidize people who are at the lower end of the rental population. Another would be an additional basis boost for extremely low income. If you rent to people, set aside to people who are at or below a much lower, then we're going to give you another basis boost that will allow more credits and make it more affordable. And all of these things are done in order to both support the preservation and to create additional housing. This bill is an important bill. It's got a lot of support. The trouble is that it's trying to get passed in an environment of tax reform, and it may take a little bit more push in order to have it done, but it does have the potential for happening. Okay, so the bill I mentioned earlier was coming from the Senate. There is a similar bill in the House of Representatives that would strengthen the housing credits, and it will include almost all of the provisions, but what it won't include is the increase in the cap, where I mentioned over 5 years you would have an increase in the volume cap that would be allowed. You won't have that in the House version of the bill. And again, the House will have a bill, the Senate will have a bill, the two will reconcile and they'll come out with a bill together. The Action Campaign is something that is a coalition of nearly 2,000 various organizations that are in the housing industry, and they've joined as a campaign together to promote affordable housing. And their mission is to try to make Congress aware in order to protect, expand, and strengthen the credit. It's one of the reasons tax credits are still on the table despite all the talk about tax reform. Their priorities for 2017 would be to protect the credit and bonds during the tax reform environment, assuring these programs remain workable, really. Expanding the credit to meet housing needs. Some of the things we've been talking about in the Cantwell bill are finding ways to make the credit more effective, and strengthening the program to make it more streamlined and flexible. All right, and the last slide is something I've been kind of alluding to. We right now do not have clear guidance or predictions on how energy credits are going to fare under tax reform. The credits that will have the least impact will probably not be extended. So the ones that I talked about that didn't get much use because the costs are very high in order to get them to be used will probably not be extended. The solar credit is probably a popular one, and the 45L credit. And the solar will probably get a lot of support, but it might not be right away because they don't have an immediate urgency. The 45L credit, you've got the housing construction industry fighting to keep that one alive. We do not think that there will be a general extension that we've had in the past. There doesn't seem to be much push for that. They want to build things into the law as it's rewritten instead of just continuing to extend. So one other thing that might help with energy credits is in the tax reform, there's a lot of push for research and development credits. And energy incentives could be incorporated through the research and development program. So we could see some motivation if people are producing credits that are going to work more efficiently, and it could be through the R&D incentives that will be in the tax reform. So that's what I have for now, and I don't know if there's any questions on this last part of the program. Donna, I'll defer to you.
We definitely have some questions. I know we're running a bit over on time, so we may not be able to get to all of them, but we have copies of them, and we have email addresses so we can get back to you that way if we don't get to it during this session.
Right. I was going to say, if anybody has questions, will they have my email to send us a question that we don't cover?
We have theirs, but yours is
Wilson
at community.com. I was trying to remember if you were .com or .org. Yes, Wilson at enterprisecommunity.com. Okay, so let's get to some questions. Let's see. Regarding credits, how is the price paid by the investor for the credits determined? What considerations go into it?
Well, the price is pretty much driven by what kind of return they want to make on the project, and so if they're looking to make a certain return, we don't always know what that return is. Sometimes they've determined it based on their own criteria, but we have an idea. When we price the numbers, we want to hit that return, and that return is going to vary based on what they can do with alternative investments. So the price is going to be a function of what delivers that return. If money has to go in earlier, then the price will be lower. If the money can go in later because maybe they bridged the construction cost and we don't put money in, the investor doesn't put money in till after construction is complete, that's going to drive up the return, and they'll be willing to pay a little bit more for it. The other factor is what else is driving the investor. There's something called the Community Reinvestment Act, and the Community Reinvestment Act requires financial institutions to invest in the certain activities that are in the communities in which they do their business. And they have to do that as a financial institution. If they're driven by something else, their prices will be higher because they're not only trying to get a return, they're trying to meet some other requirements.
Okay. Who publishes the rates for the 9% and 4% credits?
These come out by the IRS on a monthly basis. Usually they come out in the preceding month about we will expect to see the April rates at any time because it's usually the third month of the week. We'll see the rates of the month, we'll see the rates for the next month. So around the third week of March, we'll see April's rates published. In fact, I'm looking at the table, April's rates are out. So it's right around this time that you'd see it.
All right, let's take a couple more, and then we'll wrap. If you were to guess, what loan-to-value ratio do most LIHTC apartments have? Your example had about a 15% loan-to-value.
That's not loan-to-value, that's debt coverage, I think. When you say loan-to-value, actually that may be, say, a similar percentage. It's not a matter of loan-to-value in most of ours. It's really a matter of what the project can afford. So most of the time when you look at loan-to-value, it's going to give you a much higher number that you could borrow, but the project can't support it. So in most of our cases, it's going to be based on what the project can afford based on NOI.
Okay, and our last question for today, again, we will be getting back to you by email with anything we missed. But if you have solar panels and you are connected to sell energy back to the utility, is that income allowed in tax credit projects? I understand it's non-residential income that's not allowed.
Right. It would be income to the partnership, but it wouldn't really affect the low-income project unless it were a huge number, in which it might cause you to use a different depreciation. But typically, it would not get in the way of doing the housing.
Okay. And with that, Sue, I'm going to turn this back to you if you have any final wrap-up words for us.
No, I don't, but I want to encourage, if anybody has questions, to send an email. You can send it to me or mcarroll at the same address, enterprisecommunity.com. And, please feel free to do it. It'll take us a few days to get back to you, but we'll get back to you. And thank you for joining us. Now, next week, there will be another presentation on new markets and the historic credit. If you can make that one, I think it will be very helpful as well.
Wonderful. Thank you, Sue and Myra, and to all of today's attendees. We hope to see you this time next week or at any other of our Enterprise Live Online events. This now ends today's session. Goodbye.